Let's study the leases, which is IS 17. And this lesson, we are looking at a discussion about leasing, which is common in financial reporting, intermediate, as well as advanced financial reporting. In this lesson today, we will discuss um, more about leases, which is IS 17. And we take an example from the past papers, December 2022, question 1B, Kenya Accountants and Secretaries, National Examination Board, KASNEB. Now, lease is an agreement whereby the leaser conveys to the lessee in return for a payment or series of payments a right to use an asset for an agreed period of time. So leasing means therefore that if you want to use a machine, mostly the non-current asset which is too expensive to acquire, and you are using this particular machine for a few years, then there is no need to purchase this machine which may be too costly. Therefore, what happens is that if, for example, you have a construction and you may need a machine which costs 10 million, and this construction project will take 2 years, then why should you spend 20 million to acquire this machine which will no longer be in use after 2 years? So the prudent thing to do as an investor is to have this machine by use of the lease itself. That is, you approach a leasing company, the leaser, and then they will grant you this machine. You use it for 2 years as you pay for the rent for this particular machine, maybe each year or per month. So that is what will happen. Therefore, if this machine would have cost you 20 million shillings, then it will cost you less if you are to pay, if you are to acquire this machine through leasing agreement. So that is what we mean by that point, that a lease is an agreement whereby the leaser conveys to the lessee in return for a payment or series of payments a right to use an asset for an agreed period of time. So in this case, you'll be paying maybe by the start of the year or by the end of the year. The leaser remains the owner of the asset, while the lessee has the right to use the asset for agreed rental payments to be paid over a given period of time. So obviously, there is no transfer of this machine from the owner to the lessee. In most of the cases, as we will see in a while, the owner of this machine still retains the ownership. And as you see the two different types of leases, that is operating lease and finance lease, you'll be able to understand the concept of ownership and the transfer of this ownership of this particular machine. That is the point there. So the leaser remains the owner of the asset, while the lessee has the right to use the asset for agreed rental payments to be paid over a given period of time. That's very important point there. The aspect of paying rental payments, because when you go to the computations, that point of rental payments becomes critical part of the calculations, because we need to calculate the present values of those rental payments as at today. For example, you lease an asset for 5 years. It means that you are using this asset for 5 years. Then as at today, what is the present value of those future payments that you'll be making in the next 5 years? As at today, that's important point that we need to note as at this level. Most business entities use assets which they have not yet paid for in full. Those assets would either be taken back to the owner or would remain in possession of the business entity. These kind of arrangements are called lease contracts. And leasing is a major form of off-balance sheet financing, though disclosure of leased assets and corresponding obligations in financial statements are now increasingly required internationally. Whenever you have a finance lease or operating lease, or let me just say whenever you have a lease, because we have not mentioned the difference between finance lease and operating lease. Basically, whenever you have a lease arrangement, obviously it creates an aspect of an asset as well as a liability. There is an obligation. There is creation of an asset as well as an obligation. In that case, when it comes to our calculations, we should be able to establish the asset created as a result of this arrangement and the obligation created. Obligation means liability in these leasing arrangements. So to understand what is the asset and the obligation created, obviously, we need to calculate the present value of these rental payments. Then we compare with the fair value of the asset. Then we take the lower amount to represent the asset, and then the other figure or the higher figure now will represent the obligation or the liability. Now you will be required to understand that basically there are three types of leases, but as far as our discussion is concerned, or as far as the examiners the examiner is interested with the two major types, that is finance lease and operating lease. We still have another type of lease known as leveraged lease, but the focus for the purpose of the examination should be finance lease and operating lease. Now, finance lease, which sometimes can be called a capital lease, is a lease that transfers substantially all the risks and returns incidental to the ownership of an asset to the lessee. The title of the asset may or may not be eventually transferred. It is a lease under which the present value of the minimum lease payments at the inception of the lease exceeds or is equal to substantially the whole of the fair value of the leased assets. This method of financing the asset is similar to that of borrowing for acquisition of an asset. The asset is acquired immediately without making any payment for it. Contract made under this type of lease is irrevocable or non-cancelable. The leaser will try to recover his original investment of equipment plus a reasonable return on such investment during the lease terms. We should be able to understand characteristics of finance lease. Now, finance lease, one of the characteristics of finance lease is that the lease or the lessee has the option to purchase the asset. So if, for example, the lease term is 5 years, then it means after the expiry of the 5 years, the lessee has an option. You can purchase this particular asset. So that is one characteristic. That is, the lessee has the option to purchase the asset. The other characteristic is that the lease term is for a major part of the economic life of the asset. For example, 80 years of the economic life of the asset. Now, that's the important point, which gives a major distinction between finance lease and operating lease. That is, finance lease. In finance lease, the lease term is for a major part of the economic life of the asset. If, for example, the economic life or the expected economic life of the asset is 10 years, then the lease may be 9 years. So if you lease this asset for 9 years and the economic life is 10 years, it means by the time the lease term is expiring, this particular asset is only remaining with only 1 year. So the lease term, the 9 years, covers a major life of the economic life of the asset. For example, 90% or 80% of the economic life of the asset. That's a major characteristic of finance lease. The other characteristic of finance lease is that the leaser transfers ownership of the asset to the lessee by the end of the term. So it is possible that by the end of the lease term, the owner of this particular asset may transfer the ownership to the lessee by the end of the lease term. Another characteristic is that if the lessee cancels the lease agreement at any time, any cancellation losses incurred by the leaser will be borne by the lessee. Then next characteristic is any fluctuation, gains or losses will be borne by the lessee. Then maybe at the inception of the lease, that at the inception, that is, of the lease, the present value of the minimum lease payments must be approximately above 90%. Now, those are characteristics of finance lease. If you want to know characteristics of operating lease, is the opposite of those characteristics of finance lease. So this is a lease other than the finance lease. That's the operating lease. Any lease other than the finance lease. That is any lease with characteristics opposite to those of the finance lease. So the opposite of the characteristics of the finance lease are the characteristics of the operating lease. So the operating lease is also called cancelable. You have said finance lease is not cancelable, but for operating lease, it can be cancelable. A lease is classified as an operating lease if it does not secure for the leaser the recovery of its capital outlay plus a return on the funds invested during the lease term. Thus, the asset should be treated by the leaser as a fixed asset, and rentals receivable should be included in the income over the lease term. Costs, including depreciation incurred in earning the rental income, should be charged to the income statement. Initial direct costs incurred by the leaser in negotiating and arranging the lease should be expensed in the year in which they were incurred. Lease rentals in the books of the lessee should be accounted for on an accrual basis over the lease term, so as to recognize an appropriate charge in this respect in the income statement with a separate disclosure thereof. The excess lease rentals paid over the amounts accrued in respect thereof should be treated as prepaid lease rental and vice versa. So up to that point, I think we have understood the difference between finance lease and operating lease, as well as the entire concept of leasing or leases, how they operate. Situations whereby there are those situations whereby a person needs a particular asset. However, a person needs a particular asset, but this asset, you want to use it for a few days or a few years. And this asset is very expensive. So why should you purchase an asset costing that million and you are using this asset for only 1 year or 5 years? So where will you take this asset? In other words, as we will see maybe within the course of our discussions before you take your examinations before the end of the year, when an asset is in that situation, we talk of impairment. An asset has been impaired. This asset is no longer being used. So if you are having a project whereby you need a certain machine, and this project is taking a few years. Once you acquire this particular machine, and then after you complete the project, this asset is no longer being used. It has become impaired. So to avoid such a scenario or such a situation, the concept or the aspect of leasing comes in. Is a way of financing a business whereby you just need to rent an asset and you'll be paying maybe uh, rental payments maybe per month or per year. And then once this lease term expires, if for example it was for 5 years, then you have an option to return this particular asset back to the owner, or an option to purchase that particular asset. A situation where the leasee has an option to purchase, we have mentioned that that situation is known as, or that type of leasing is known as finance lease. Because with finance lease, you have said the lease term covers a major part of the economic life of this particular asset. The asset may have 10 years, but you lease this asset for 8 years. So by the time the lease term is expiring, this asset has only 2 years remaining for its economic useful life to lapse or to expire. Now we have, I think, we have that introduction about leasing. Remember, leasing is IAS 17. I'll still discuss about leases under IFRS, that is International Financial Reporting Standards, which is a theory part of it. We should be able to look at the comparison or any relationship between International Financial Reporting Standards with respect to leases, as well as International Accounting Standard concerning leases as far as the same is concerned. Now, as I have said earlier, we wanted first to know what leasing is. So you should be able first to understand what is a lease, how it arises, why it arises. I've said there are 3 types of leases, but concentrate on finance lease as well as operating lease. That's the major thing. Now, I want us to look at just a simple question here, because we'll be doing we have started this advanced financial reporting from chapter 1, advanced financial reporting chapter 1. So we will be moving from chapter 1, 2, 3 up to the last chapter. So if you are taking advanced financial reporting, I think you should be part of us, so that within the course of 1 month or 1.5 months, that is around 90 days, we should have completed all the chapters for advanced financial reporting. So we have just started from chapter 1, and as far as your syllabus is concerned, leasing is in chapter 1. So we are doing leasing, so you should be part of us as far as this discussion is concerned. So we want to, because we have introduced what leasing is, the types of leasing, why it arises, what are we trying to avoid, why are we not purchasing this particular asset, why are we trying to rent this particular asset. It's like, for example, if you are a student and you have an examination and you need a scientific calculator. You have an examination and you need a scientific calculator, and the cost of scientific calculator is shillings 1,000. You have an examination for only 2 days. So what you can do is that you can have a friend of yours whereby you can pay this friend of yours 50 shillings per day for the 2 days that you have an examination. So in that case, you not spend 1,000 shillings to acquire the calculator, because you need the calculator for only 2 days. So you can pay 50 shillings per day, the second day 50 shillings, 100 shillings. In that case, you have saved 900 shillings. So that is the concept of leasing. So we want to take an example from advanced financial reporting, December 2022, question 1B, and this is KASNEB, the Kenya Accountants and Secretaries National Examination Board. Now, let me see whether we'll be able to see that question as it appears in my paper. Now, I believe most of our students have this paper with them. Is advanced financial reporting. Advanced financial reporting is KASNEB. This question 2B. Let me try to project it in my. I project it somewhere. I don't see the whether it to be legible. So it is a question 2B. It's 1B, not 2B. It's 1B. 1B is there. You are told Vox Limited leased a factory to Tiana Limited with effect from 1st July 2022. The lease is for 4 years at an annual lease rental of shillings 4 million, payable annually in arrears. The lease contract provides that the lessee shall be responsible for the insurance and maintenance of the factory during the lease term. The implicit rate of interest in the lease is 15% per annum. Required. Demonstrate with suitable calculations the accounting treatment of the above lease transactions in the financial statements of Vox Limited, who is the leaser, for the years ended 30th June 2023, 2024, 2025, and 2026. You are given 10 marks. I've said it is question is December 2022, question 1B. You can see 1B there. That's 1B. Vox Limited leased a factory to Tiana Limited with effect from 1st July 2022. The lease is for 4 years at an annual lease rental of shillings 4 million, payable annually in arrears. The lease contract provides that the lessee shall be responsible for the insurance and maintenance of the factory during the lease term. The implicit rate of interest in the lease is 15% per annum. Required, demonstrate with suitable calculations the accounting treatment of the above lease transactions in the financial statements of Vox Limited, who is the leaser, for the years ended 30th June 2023, 2024, 2025, and 2026. You are given 10 marks. Now, that's your question. I believe you have seen it. You can, because I believe most of you have the past papers. The past papers is not an issue with KASNEB. You have those past papers. Now let me read it as I explain here. Vox Limited leased a factory to Tiana Limited with effect from 1st July 2022. The lease is for 4 years at an annual lease rental of shillings 4 million, payable annually in arrears. The lease contract provides that the lessee shall be responsible for the insurance and maintenance of the factory during the lease term. The implicit rate of interest in the lease is 15% per annum. Required, demonstrate with suitable calculations the accounting treatment of the above lease transactions in the financial statements of Vox Limited, who is the leaser, for the years entered 30th June 2023, 2024, 2025, and 2026. What are we supposed to do in that case? Now, as I told you, that whenever you lease an asset, you are supposed to pay rentals, maybe each year or a month, whichever the case will be. Now, important point to note here is that if you are told that payments are being made in arrears, it means that you are making these payments by the end of the year, that is by December. Sometimes you can be told that payments are being made by the start of the year. From the financial management concept, I think you know the concept of ordinary annuity and annuity due. Annuities are those cash flows which are constant. That is maybe 20, 20, 20, 20, or 10, 10, 10, or 70, 70, 70. That's an annuity. Cash flows which are constant. Now, a cash flows which occur by the end of the period or by the end of the year are referred to as ordinary annuity. And I believe you know the formula for calculating the present value of those annuities. You just take the annuity, that is the figure which is being paid. For example, if you are paying that thousand, that thousand, that thousand, you take that thousand, you multiply by 1 minus into brackets 1 plus r raised to negative n divided by r. That is ordinary annuity. If cash flows are occurring by the start of the year, that is annuity due, you just need to adjust that formula by multiplying it by 1 plus r, 1 plus rate, and you will have calculated the present value of those annuities due. That is the cash flows occurring by the start of the year. That's boring. Again, you can read those figures from the tables which are given, mostly in financial management. But in financial reporting, sometimes they may not give you that table for reading the present values of cash flows. Well, let's now this part, what I'm trying to say is that whenever you are given a situation where there is a leasing arrangements, the first thing to do is calculate the present value of those particular cash flows. In other words, initial lease investments is what you are supposed to calculate. The initial lease investment, which is the initial lease investment will be the equivalent of the present value of lease rentals receivable, i.e., the shillings. I think in this question we are given 4 million because they are paying 4 million for these 4 years. So the initial lease investment for us or for this lease arrangement entails calculating the present value of these 4 million which they are paying as at today. And we are told that these payments are being made in arrears. They are paying by the end of this particular period. Well, now that is why here, if you look at your calculation here, we are saying A times present value annuity factor r percent n. We are told interest rate implicit is 15%, and this arrangement is for 4 years. So what are we supposed to do is, because we are paying 4 million, you multiply by 1 minus 1 plus interest rate implicit raised to negative 4. Negative because you are calculating present value, not future value. We are concerned with this 4 million you are paying for the next 4 years. what is the present value of those figures as at today. That's what you have done here. Then you divide by the rate. Rate is 15%, 0.15. So understand here. But if you use the tables which are provided in financial management, you just go to 15%, then you look at year 4, that figure is given there, then you multiply by these cash flows, the 4 million. But because here the tables have not been provided for calculating the present value of the annuity, what we have done is that we use this formula. Remember that these cash flows are ordinary. This is an ordinary annuity where cash flows are occurring by the end. But if you are told that cash flows are occurring by the start, that is, they are making the payments by January, you just need to multiply this formula by 1 plus R if cash flows are occurring by the start. But that is not the case here. Our cash flows here are ordinary annuities. So if you work out this particular section, then you get this figure. If you go to your table, the tables provided in financial management, if you look at 15% and 4, you'll be able to establish this number there. But the other way of calculating it is that way. So if you work out this, multiply by 4 million, you get 11,420,000. So that is our initial lease in that particular investment, calculating the present value of those rental payments was the first step. So we got this figure here. Now the next thing, because the examiner required you to demonstrate with suitable calculations the accounting treatment of the above lease transactions in the financial statements of Vox Limited for the years entered 30th June 2023, 2024, 2025, and 2026. Remember, Vox Limited is the leaser, is the owner of this asset. Now, the income to the leaser is an expense to the leasee. So we are preparing the books of accounts of Vox Limited, and Vox Limited is the leaser, is the owner of this particular asset. So what happens is that, now let's start here before we come to that concept of who is receiving the money and who is paying the money. Where there is an income, the other person must be incurring the expense. And where the other person is incurring the expense, the other person must be talking about income. So up to this, I think we are okay. This is a concept which you have done in financial management. So what you do is that you prepare a lease amortization schedule, just as you have done in financial management, where you usually prepare loan amortization schedule. You see, this thing is just like a loan, only that you are being given an asset with a certain value. This is the same as somebody who went to the bank, acquired a loan of 4 million and is paying interest of 15%. Only that in this case, you have not been given cash from the lender. The lender has given you an asset with a value of 4 million. It's the same thing here. That is why the amortization is coming in. With the loan amortization schedule, you used to say that whenever you make an annuity payment, that annuity payment comprises of interest and principal. So you have to separate that annuity payment to know, out of that annuity payment that you are making, what portion constitutes the principal and what portion constitutes the interest. Now let's come back here to the loan amortization, the lease amortization schedule. So there are 4 years, as we have been told that the lease is for 4 years, 2023 to 2026. So you can use from here, instead of writing 1, 2, 3, 4, these are the years. You can write 2023, 2024, 2025, 2026. Then balance brought forward here. So you start with this one. That figure there is what you start with. So you start with 11,420,000. The figure you have calculated up here. This figure here is what you start with there. Then interest, this column is for interest. The interest rate implicit you are told is 15%. So take 15%, you multiply by that particular figure, you get 1,713,000. Now this column here, these receipts, the column for receipts remains constant because it is what we are paying per year. This figure here, the annuity, each year we have listed this particular asset, and then each year we are, by the end of each year, that is by December, we are paying 4 million. We are paying 4 million, that figure. We are paying 4 million there. Now then, so this one you can, when you are preparing the lease amortization schedule, you can fill in this part straight away without wasting time, because these figures don't change, they remain the same. Now once you get these, then you go to the principal amount. The principal amount. Now the principal amount, you'll be taking the receipts, you minus the interest. The receipts minus interest. So you'll be lessing receipts minus interest. The receipts minus interest, to be getting the principal, because you are separating. I've told you the way you do in a loan amortization schedule, where you have the annuity, you have to separate this annuity, you less the interest to remain with the principal. So this one we are saying, take this particular receipt, the 400,000, you minus the interest. This figure, that now this was 4 million. This is 4 million. You minus this particular figure here, and you get this column here, the principal. Then the closing balance now will be, you can take the balance brought forward, that is the opening balance, you plus interest, the opening balance here, you plus the interest, and then you less the receipts. So note that point there, how to get the balance carried down, the closing balance, because I'll leave you with the rest now to attempt. So I've told you to get the balance carried down, you'll be taking the balance brought forward, and then you plus your interest, and then you will less the receipts, this column there. So to get the balance carried down, I think you have noted that. So the rest you can fill in. I've shown you. So this is the starting point. That's the starting point. The balance brought forward, the starting figure when preparing lease amortization schedule, calculate this figure here, which you got from here. You start with it then. And then interest, you take 15%. Interest rate implicit, 15% times the opening balance, you get that. This one I've told you is the rental payments which you are making, which is constant throughout. You have no problem with this one. Then the principal figure, you just take the receipts and then you minus the interest. This one here, I've told you take the receipts. This column here, 4 million, you minus the interest, which is here, this column, to get that. And then the closing balance now, because you have separated, we need to know what is our balance by the end of that period. I've told you, you'll be taking the balance brought forward, this column here. What did you start with? And then you plus the interest income, and then you less the receipts, this column here, you'll be getting that. So once you get this figure here, the year one, this becomes your opening balance here. You can see whatever is here, whatever you are closing with, becomes your opening balance. Repeat the same process. Multiply this one by 15%. This one remains constant. I've told you what you do here. Receipts minus interest. And then I've told you how to go about the balance carried out. This one becomes your opening balance. Repeat the process. This becomes your opening balance. Repeat the process. By the end of year 4, this will be a 0 because you have the lease term expires in 4 years. Now, remember once again that we have been told to demonstrate with suitable calculations the accounting treatment of the above lease transactions. Now, from here, because you should understand what is the asset here, as I have mentioned earlier, that a finance lease creates an asset as well as an obligation or a liability. Now, in this case, we're going to see what in our situation here, we expect the owner of this asset to be receiving income in terms of interest. So this column here for interest is what the leaser, the owner of the asset, is receiving. If you go to the lessee, this becomes an expense. So if you want to prepare the Vox Limited income statement, you have years, year 1, or year 2023, 2024, 2025, 2026. Then interest income, you will receive this figure here, 1,713,000. Year 2, 1,369,000, 1,369,000, and then year 4, 9. So we are saying year 1 is 1,713,000, this part. Year 2, 1,369,000, this part. Year 3, 975,443, and then year 4, 521. So remember, this is an extract. It's not the entire appearance of the income statement. It's just that particular portion showing other sources of income which was coming from leasing. Now, this person may be having other sources of revenue. So this is simply an extract. So interest to be an income. This interest here is an income in each year. These 4 years, this will be the incomes to the leaser, Vox Limited. Then Vox Limited, the statement of financial position. Now remember that the current assets comprises of principal for the next year. Now this is a statement of financial position. Now this is current assets. I've written CA and I've said current asset comprises of the principal for the next year. So year one, the principal for next year is 2,630,000, 2,630,000, 050. Should be able to see this. The principal for next year, 2,630,000, 050. So this one here, principal for next year. Principal, because principal for year 1 is this one. But we are saying current asset, you take the principal for next year. Now the next will be principal for next year, 302,455, something like that, which is the principal for next year, 3,024,557, and then 3,478,393. This figure here. So note that point here, which I've told you, that the current asset, you just take the principal for the next year. The principal for the next year. So for year 1, this principal as a current asset is not necessary because you have said for the current asset, you just take the principal for next year. So these are the current assets. And then non-current assets comprises of balance carried down for the next year. The balance carried down for the next year. So you just take what? 6,502,000. This one. The balance carried out for the next year. If you want to show the non-current assets, take the balance carried out for the next year. So for year 1, 6,502,950, and for year 2, 3,478,393. This one. The other one, no non-current and no non-current. So that is how you should have attempted that particular question, by showing the relevant, or they were asking us to demonstrate with suitable calculations the accounting treatment of the above lease transactions in the financial statements of Vox Limited for the years ended 30th June 2023, 2024, 2025, and 2026. You are given 10 marks. So that is how we should have attempted that particular question. So that is it for today. That is leasing. We attempted a question about leasing. The books of accounts, in the books of the leaser, you should have prepared his books. So as I've told you earlier, if you have advanced financial reporting, this year, that is towards the end of this year, and you have just started our classes last week, I think you should just be part of us, just be following what we are doing here in our live classes, as well as in our YouTube as well, so that you may compare. You need not necessarily be our student. You can be a student elsewhere, but whatever you are doing, wherever you are, or you are studying for yourself, or you are in the university and you are doing things which are related to what you are doing here, we are requesting you kindly to subscribe in our YouTube, and you'll be able to follow what you are doing. Then you compare with what you are doing wherever you are, so that you may get assisted as far as your studies are concerned. So we stop at that for now, but the next lesson we will take another example which is similar to this one, and then I'll give you an assignment to attempt. Now my number is 0727 87 10 93, and my name is Mr. William. So my number is here, plus 254. That's a code for Kenya. If you are in other countries, I'm sure there must be some people who are getting these lessons in foreign countries. So if you are in foreign countries, you start with plus 254. This is Kenya. 07 27 87 10 93. 0727 87 10 93. Now, for those of you who are taking CIFA, that is Certified Investments and Financial Analysis, we have books for CIFA, so you can still ask me for those books through that number or via that number. We still have books for ATD, Accounting Technician Diploma, and also CPA. We also have books for CPA. So this that number, you can use that number for our communication, 0727 87 10 93. So we can meet next lesson as we attend another example to do with leasing, so that you may understand the details. So thank you. We can meet next time. Thank you very much.